go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index is up 0.4%. Hang Seng is up 0.9%.
Debt then compounds on the debt, and it's squeezing out.
24,462 and 25,116. This is the range for the market.
Whether foreign banks should be allowed a higher ownership.
24,667 is where the Nifty started at. The Nifty Bank is at about 55,800.
Global market just want to hear one news. What is going to happen on trade tariff side?
Eternal up for another day in a row. So today it's up close to about 5%. That's the top gainer.
Monetary Policy Committee expected to cut rates for the third consecutive time. GST collections are now above 2 lakh crore rupees, which give confidence to the council to consider trimming the slabs.
Around 5 minutes back, it was mostly in the green, but now what we're seeing, a little bit of selling pressure across select names.
I think if we had started this program about an hour and a half back, I think we'd be up to about 24,900 on the Nifty. So that's been a really fast-moving market. But the direction of travel has been up, a little lower off the highs as we start this edition of Closing Bell. But that's where we are at. We are coming to you from the CNBC-TV18 Motilal Oswal studios. This is Closing Bell. I am Prashant. With me, my colleagues Surabhi, Reema and Nigel. Guys, good afternoon.
Hi. Afternoon. We're heading into the Nifty weekly expiry now and the RBI policy tomorrow. So
we are, and I think it's the green that you and I are wearing, plus the fact that it's World Environment Day.
Yeah.
It's all green. The market's chosen to go green yesterday and today. Let's see. Last hour coming up, but it seems advantage bulls for now. Nigel?
Well, that's right. Credit to your ladies for the market being in the green. But I think, we're still in that range. The markets actually earlier today, we were above that 24,800, 24,820 odd mark. So from there, we pulled back a little bit. Let's see whether the final hour of trade has some excitement. But I think looking at the options data, still the odds are that the 24,750 to 24,800 mark will get defended on the upside. If we can get past the 24,800 mark, we can have a very quick 100 points even from there. So I think that's the range on the upside. 24,800 is where the bears would like to defend. But Nifty Bank not participating again, Prashant?
No, absolutely. And I think that's the index which didn't really do very much yesterday as well. And today as well is kind of a bit of a move higher midday, but then again, nothing after that. And of course, compared to the Nifty, the move higher midday was really paled in comparison to what we saw on the Nifty. So, actually at the highest point of the day, you have to say, we basically took out, there's a channel resistance at 24,750. All that went. And we are basically back at about 24,720 and hit 24,900. 25,116 is the swing high, which is essentially a level we put out over the last many days. And that's the range that broadly, that range that we've been talking about, 24,463 in lower side and 25,116, 25,100. Let's take it that round number as the resistance as well. So it's still, flitting around in that range without very much really to show for it. Broader markets, though, I think are a different story. And just look at the Nifty defense pack once again. And as I was coming in, I was looking at this, 2.5% higher, by far the biggest gainer, the Nifty Defense Index. And that's a 200-point pop. And even if you look at stocks, right, Cochin Shipyard is the #1 volume-led gainer on the NSE with a 12% gain. But it's not alone. There is Data Patterns, which is coming up with a 6% pop. Paras Defense is up about 6% or so. And MTAR Tech is up about 5%. And so much more. Even, and Reema and I were talking about this earlier, something like Idea Forge, complete, since listing, didn't really perform at all. But just look at what Idea Forge has done and is doing today. I guess it needed that defense push in that sense, and it's performed. I think from the lows in April of $300, it's basically doubled. From the 7th of April to now, it's gone up 100%. So a tremendous move, and today as well, it's up another 5.5% or so. Let's actually talk about all of this and more with some trades as well. Mitesh is here. Mitesh, afternoon. What's your sense? Indices and then your trades.
So Prashant, on the indices, nothing has changed. Actually, we just kind of, bounced back from the lower end of the range now somewhere we hit an intraday high, which was nearly middle of the range. But I think, it still is a market which is doing 24,500 to about 25,050. Broadly, the bank nifty still remains in 56,000 to about 55,000. So, I think it's still a market which is just sideways and not giving you any kind of directional bias. Though my sense is that eventually we have a higher chance of breaking on the upside. But that is something which we will figure it out once the market kind of reach near the upper end of the range. So for the time being, suggest trading with more of stock-specific biases.
Do you want to tell us the trades that you're recommending now?
Yeah, so I think, Pharma is something which is showing good traction today. I would recommend a loop in once it starts getting past 2,000. There's a mild pivot over there, and the stock is trading just right at 1990s or 1995. So buy about 2,000, then keep a stop at 1975. Look for a target of around 2050. The other one on the radar is Zydus Life Sciences, which is a buy with a stop below levels of 935 for targets of 990.
Okay, so got that. Those are some ideas, Mitesh. Mitesh, before we let you go for now, just a word on Eternal. We'll discuss the fundamentals around the stock in a bit, but the price action has been very interesting. After being absolutely, down and out, suddenly there's traction, volumes, and price moves as well. What do you make of it?
So it's been on a recommendation list in the last few days. There's been a good breakout, and the eventual target or the near-term target, which was around 260, has been met. Now, if you rewind a few months back, when the stock was falling from highs of 300, there was a big gap down between levels of 263 to about 258, and I think that gap has been attempted. So I think if somebody's having short-term positions, the stock in the last 5 days has moved up from 230 to about 260. Time to take profits over here. The 200-day average is at about 245, 47 zone. So if you get a decline, pull back to those levels, re-enter again, or wait for this gap to be filled. So buy about 264. Eventually, I think the stock will head towards 290 odd levels. But in the short term, one leg of move seems to be done.
Swiggy's taken a bit of a backseat today. That's flat. And the one which is moving is actually First Cry or Brainbees. Big move on that stock, up close to about 9%. Came out with numbers towards the end of May. The company's net loss had widened. The stock slipped above 4%, went down to levels of 360. And since then, from the 27th of May, it's climbed back up to about 395. And a bulk of that move has played out today. One other big mover, actually it's been a big mover for the last, years now. That's Coforge. So JP Morgan has written on Coforge, and they say that Coforge is their APAC conviction call. They're calling the stock their all-weather growth champion. It's the top pick in the IT space, target price 2080, 20% upside from current levels. So top down, what they are saying is that the recent analysis of the clients of the IT companies, so they've all reported numbers, whether it's banks, consumer names, and the key sense is that the IT spending environment has not deteriorated, and therefore IT companies may not see significant earnings downgrades. So in that sense, the top-down setup is fairly attractive. But now bottom-up, when they look at and do the analysis, Coforge is right on top. Because one, this is one of the few companies where FY26 growth will be better than the FY25 organic revenue growth. So more than about 15%. Secondly, the company will continue to outpace peers in terms of growth. And look at the growth that JP Morgan's anticipating. A 19% compounded revenue growth for the next 3 years and 25% EPS compounded growth, CAGR. And that's higher than what the other companies are likely to report. And if they look at the valuations, they're saying it's not expensive. Given the growth, the company is trading at a PEG ratio of 1.7 times, which is cheaper than many of the other IT companies which are trading at 2 to 3 times. So fast growing, and keeping that in mind, the valuations are also fine. It's their all-weather growth champion. That's the title for Coforge by JP Morgan. Devin Choksi is now with us. Devin, stock is corrected a bit. So has the rest of the IT pack, but even Coforge has. Would you buy it at these levels?
Good afternoon, Dimon. Well, I think when you look at the valuations of the company, probably I think these particular growth numbers which are being projected, I think they're fully reflecting into the price as I see it. So whether it is an immediate buy opportunity or it is a momentum buy opportunity, I would think that it would be more of a momentum buy opportunity at this point of time. Fundamentals, though they remain, I think, convincing at this point of time, and I think suggesting that the growth will continue for 2-3 years. Having said that, I think the valuations are factoring most of it in my viewpoint. So as a result of which, wouldn't like to immediately, I think, put a buy. But yes, I think momentum remains strong. So as for traders, I think this could be, I think, a different story. Investors, they can wait for buying.
Okay, all right. Hi, Deven. Good afternoon. Good to see you, Ben. Deven, what about Eternal or the erstwhile Zomato? One would have expected the stock to be under pressure. All the rejig, the foreign selling that took place in the last week got absorbed very, very quickly. And importantly, in today's trading session, the stock has crossed past its QIP price, which was at around 252. And we know that at that point of time when they did the QIP, there was a lot of appetite. Your view on the stock today, it's one of the top gainers on the Nifty.
Hi, Nigel. Afternoon. I think largely also the fact that they have been tweaking around with their revenue model. They have been playing around with the revenue model, along with Blinkit, I think, where the larger number of orders are getting executed, wherein the Blinkit is expected to cross what Zomato is basically doing in the Eternal's umbrella. I think they are likely to cross, combined together, I think likely to cross significantly large number of orders that they are executing. And given the success of platform fees, given the success of other fees other than the platform fees which they've been charging, I believe that I think probably the revenue could go up from current levels. However, I think when you look at the valuation and the price, probably I think everything is discounted in the price. One would rather like to enjoy the services I think that this company is providing to the consumer rather than I think buying the investment, unless I think you are a momentum trader.
Okay, all right, got that. Deven, thanks for it. We do want to discuss, of course, the whole EV situation and what to do with some of these EV stocks. Before that, maybe we can go across to Parikshit and get the latest on this big story that's playing out. China restricting the supply of rare earth magnets, something which is a very important input for the EV sector. Parikshit is back. Parikshit from his US trip, of course, which was quite eventful. Good to see you here on the screen again, Parikshit. What's the latest you're picking up? I mean, what are the options that perhaps the government and the industry are considering to mitigate this situation?
Well, you spoke about US. In fact, we're told by top sources in the government that China's aim by restricting supply of rare earth magnets is actually the United States. And that's because of the tariff war that Donald Trump has unleashed. And this is China's way of telling the world that the supply chain of critical minerals, critical materials and components lies in China. And you cannot impose harsh tariffs or try to arm twist China in that sense. But yes, India is getting into a big problem. We've been told that no consignments of rare earth magnets have come to India post the 4th of April when this new notification came into effect by the Chinese government. What we are doing about this? Well, there have been high-level meetings at the Prime Minister's office, the Ministry of Heavy Industries, the Ministry of External Affairs and the Ministry of Commerce. All your top ministers are aware of this problem. For the moment, there doesn't seem to be a solution apart from the fact that you follow the protocol that is being laid out by the Chinese government. That is, you fill out the performer, the form which basically is a guarantee that you're not going to use this for dual use, you're not going to use this for weapon systems, and this has to be cleared by the Chinese government. So it is a long procedure and consignments for India are not being cleared, is what we are being told. There is a plan, there is an industry proposal to allow the industry bodies, the automotive industry bodies, to travel to China to meet Commerce Ministry officials there, but clearance for that is yet to come in. The Indian government is considering this proposal. What are the options right now before the industry? Very few. Number one, rather than importing just rare earth magnets, you import a full sub-assembly. That is something that we can do from China, but that is a problem. Problem is you have quality control orders which bar you from doing so. Number two, you have criteria in the PM e-drive scheme, also in the PLI scheme, and if you're a beneficiary of those, you will be actually contradicting the criteria. So the government will have to tweak that. But yes, the government is considering industry's proposal to get full sub-assemblies from China. Number two, you can also look at getting supplies from countries or companies which have a pre-existing inventory of rare earth magnets. The problem there is the cost and whether such a company would be willing to give inputs to India at such a point. Number three, companies which have inventory of rare earth magnets would like to stagger production, probably reduce sales, reduce production, but keep the sales going in some way or the other. And those which do not have enough running stock, they may have a problem of actually shutting down production altogether.
Okay, so it seems like a pretty complex situation at this juncture till some sort of a breakthrough is arrived at. Parikshit, thanks very much for that. Let me take this back to Deven. Deven, obviously, we need to see how this gets resolved. All the companies have gone on record admitting that this could impact production quite severely. But if we park this magnet problem aside for a bit, I mean, how would you be willing to play the EV ecosystem, if at all? I mean, Ola has been a very bitter lesson for investors. Ather is in the market now. You could play it via existing, giants like a Bajaj Auto or TVS for that matter. Any picks here on the EV side?
Yeah, I think, as you mentioned, the established player like Bajaj Auto, I think, remains relatively more comfortable bet. Yes, they too get affected, I think, if this magnet problem persists. But in my viewpoint, I think this company has relatively better handle to, run the subject. And that's where we remain more comfortable compared to their newer entrant peers who are physically struggling on various other accounts. So maybe I think because of Bajaj Auto's strength also in the three-wheeler, four-wheeler kind of a vehicle, which is commercial vehicle in the EV space, I think this company has relatively much better amount of say in the marketplace, and so it is making money as well. So we remain otherwise very positive. Hope this particular magnet problem gets resolved in a quicker time. Then probably I think the growth could be in double digits for a company like Bajaj Auto as we see it.
No, absolutely. And I think, June, July, essentially, as Parikshit also pointed out, because the restrictions came into effect early April. So, and with, you count the inventory out, which companies have, maybe now we'll start to see. But as Parikshit said, I mean, we'll have to deal with it. And this is largely aimed at the US. And of course, everybody gets hurt in the process. But, it's the US, the China is really focusing this on. What else? I mean, I think we should just look at maybe a quick word on something like an Idea Forge. I don't know if you've looked at this one, but it's a massive move, huge underperformer since listing, and it's still nowhere close to the high. Was I think of almost about $1,400. Stock's at 600, but the point is, it's come off the lows a month ago. The low was about 300 rupees, so 300 to about 600. Is this generally this rub off on defense, and they do a lot of defense drones? So is that rub off, or is it something to do with numbers? Have you taken a look?
Yeah, Prashant, I think the market is super excited with the drones business of, I think, most of these companies. And why not? I think they're launching the newer drones, newer range of drones, and they're getting, I think, the orders as well. However, I think in this excitement, we are seeing a significantly large amount of premium given to most of these companies. While I'm not against the fundamental, I find that I think the valuations are fully reflecting everything. There is going to be an opportunity for making India kind of a drones, I think, which are getting exported. So that is going to be a big time opportunity. However, it would significantly demand a large investment or a big investment for most of these companies, one. And that too, it will take some time, a couple of years before which I think this starts delivering them. So in my viewpoint, yes, in the near term, everything is in the price. Maybe market correction would be a better opportunity to buy into companies like Idea Forge.
Okay, all right. Thanks a lot for that, Deven. But I think Ekta is standing by. She's here to update us on a few of these pharma names that are bucking the trend. Ekta?
Well, yes, I'll start with Dr. Reddy's, where HSBC has upgraded the stock to buy from hold and a target price of $14.55. According to them, semaglutide is a big fat opportunity, and the sales will help return to EPS growth path within a year of launch in terms of key markets. They bake in semaglutide sales of $280 million in FY27, mainly driven by the Canadian market. Lupin and Zydus are in focus on the back of an Axis cap note. A US court has allowed Lupin and Zydus to expand their patent argument scope on mybetriq generic, and other generics such as MSN as well as Ascent are pursuing full argument scope. So basically, Lupin as well as Zydus have just joined the other generics in terms of expanding it. Lupin and Zydus will now, according to them, have more ammunition to defend their at-risk launch, which is They did that in April of 2024, and it will possibly reduce the financial penalty as well. Wockhardt held its investor call today. They expect the antibiotic drug Xenage to be in the Indian market by mid next year. They expect to market the drug in the US sometime in 2026-2027. They expect 80 to 100% growth in the top line over the next 3 years and move to margins of around 20% by then.
Okay, all right, Ekta, thanks a lot for that. Well, Devin, coming back to you, what's your view on these pharma names?
Well, yes, I think definitely some positive news from companies like Dr. Reddy, who is entering into the agreement for the biosimilar, where the business, I think, looks, pretty stable, or maybe, I think, quite exciting for growth purpose as well. Not completely sure about, I think, what kind of margin addition it would do, but the fact remains that I think they are entering into this particular segment, I think, which is just opening up. So in my viewpoint, I think the likes of Dr. Reddy could remain relatively more stronger going forward as well. Fortunately, I think the other side, I think there is a cost side of the activity, I think is largely under control. So promises to be better margin in this current financial year 25-26. At the same time, I think the continued growth in excess of 15% in the business. So certainly, I think remains positive. Valuation-wise, not too expensive. Maybe I think the market is giving opportunity at current levels and maybe at lower levels further opportunity.
Okay, I think what we're going to do is we're going to take a quick commercial break here. Devin, thank you very much for that perspective on a bunch of issues, a bunch of stocks and sectors as well. Really appreciate it. Well, what we're going to do is take a quick commercial break here. We're going to come back and get you Jigar Mistry, who's going to be with us on the other side. Stay tuned.
Inflation is set to remain below 4% for this entire year, even go as low as 3.5%. So should the Monetary Policy Committee and the Reserve Bank cut interest rates by 50 basis points this time? Or should they remain cautious because growth is strong, as the fourth quarter GDP numbers indicate? Watch the monetary policy on CNBC-TV18 on June 6th, along with a band of expert economists and policymakers who will decode for you what the policy means to your investments, your savings, and your business. Only on CNBC-TV18.
The RBI monetary policy at these times.
Okay, welcome back. We got the market, which is actually absolutely flat, and we got the Nifty bank that is flat. The Nifty is up 140 points, right where it was when we started at 230. Jigar Mistry is with us now, co-founder at Buoyant Capital. Jigar, good to have you back on the program. Thank you for joining us. Let's just zoom in straight to what's happening on defense, Jigar. It's of course there is a real story which is playing out in terms of indigenization, etc. But I worry whether we're getting kind of swept away as investors. Some of the rises are really you get scared. Look at what's happened with Mazgaon or even Cochin today. What is your sense, Jigar? Have you looked at this space in any detail?
Right, Prashant. So, good afternoon. Great as always to be on your show. We have not looked at it in a great detail, but I think what's really happening is that whereas there is a very clear-cut case of a lot of incremental government spending, given that, let's call it a skirmish between India and Pakistan, and following that, India across the board sort of showed a much stronger presence. Naval and Army was always strong. The Air Force was much stronger this time around. And clearly, we see that as a win of more of a DRDO-led sort of process rather than the companies-led process. Now, obviously, the governments are going to spend a lot more, but I doubt if a lot more of these orders are going to come to these companies. If anything, India did well, despite the delay that many of these companies have caused in delivery. Could be sort of Tejas aircrafts, or maybe Vishal, the new sort of aircraft carrier. Just because sort of the wave is so positive in and around this space, if you check the number of shareholders that many of these companies have gained over the past 2 years or so, it tells you that it is much more sort of a frenzy, which you cannot really justify if you try to do a reverse DCF on a lot of these businesses. So whereas we are interested in this space, but it's difficult to buy a business without sort of having a very large leap of faith.
So you don't own anything in this space, right, Jigar?
No, not really anymore.
Jigar, in the past, you have tracked IndusInd Bank. Is it a part of your portfolio?
No.
Okay. But what have you made of the series of irregularities that have crept up in IndusInd Bank? And as an investor, do you think the worst could be in the price? Because incrementally for bad news, it's not that the stock is falling. But at least for now, do you think the bottom may have been made, even though the recovery takes some time? I mean, how would you approach IndusInd Bank now? Or think about it?
So I think, whenever you buy a microfinance business, that's always a tricky one. If you remember, Vikram Akula wrote a book, Micro Meltdown, and that's widely considered to start in and around the same time Mohammed Yunus started Grameen in Bangladesh. Now, the cumulative profit that SKS Microsystems made between 2000 and 2010. They had to write off twice the amount of cumulative profits in 2011 when the Andhra problems crept up. So it's an extremely cyclical business. And therefore, these institutions have traditionally sort of stayed separate from the overall bureaucracy of a banking system that it brings. When that size is very large compared to the other traditional banking assets, there is a propensity for sort of, bad news to creep up, which the traditional management either may not be fully aware of or may not be all that willing to acknowledge. So I would say just the construct of the system was such that this was not entirely unexpected. Once that has transpired, we don't really know if all of it is in the price or not. But as you said, the price has held up fairly well. And if somebody had some space left in the turnaround story brackets, then I think it might make for a reasonably interesting business to at least start looking at. But frankly, at least we don't know on whether that is the case or not, so we don't own it as yet.
All right. Hi, Jigar. Good afternoon. Good to see you. And Jigar, I need to talk about our core sector. This time I'm asking you about silver. Silver has actually underperformed what gold has done. And we know here in India, there's only one way to play it, right? Hindustan Zinc is the only one that you can play if you want to play the silver uptick. And as we speak, it's hit 1,04,000 rupees per kg, which is the lifetime high. What's your view on silver as an asset? And I think you were positive on the conglomerate, right? One of the largest metal conglomerates here in India, Vedanta. Tell us more.
Hi, Nigel. So yes, gold became sort of more like a no to dollar than a yes to gold, right? Obviously, Indian households own gold for various reasons. But if sort of I'm a global asset allocator and I'm seeing dollar index fall from 110 to below 99, I have 2 or 3 options to get in. Maybe I can allocate more to emerging markets, but then China on a rolling return basis hasn't made me money. So what else can I look at? That goes true for most countries that are, looking to de-dollarize in whatever shape and form they can. Now, Western economies, like say Canada, I think sold a large part of its dollar 2 decades ago. So Western economies don't de-dollarize by gold, but at least India, China, they would do that, looking at gold and various other things which are non-dollar. And therefore, when you denote the price of these commodities into dollar terms, that will sort of show a reasonably decent increase. Now, again, we go back to traditional formats. We always used to have these gold to silver ratios, and those ratios started hitting at the low, and now that gold doesn't really have a propensity to go up. So let's sort of all buy silver. So I think it's part of that whole age-old cycle, which will keep repeating itself. Our sense is that the way in which it sort of manifests into an equity investment in India are the 2 names that you just mentioned. If you get some decent liquidity, then the zinc asset may make some sense. But in absence of which, if you're generally positive on the commodity complex, which we are, then I think the conglomerate makes a lot more sense. So I would say the silver to gold is much more a cyclical play, more a no to dollar than a yes to gold or silver. But the way to play this is to buy commodity stocks.
Okay, got that point. Jigar, hi, good to have you on the show today. Finally, before we let you go, tomorrow's RBI policy. Everyone's expecting rate cuts, maybe tomorrow, and of course, more further down the line. But the question is, what should one play, in financials? Because there's one worry about whether NIMs will come under pressure, because the moment those rate cuts happen, you have to pass on to your end customers. By the time your deposits are repriced, it takes a while. So NIM pressure is a concern. But on the flip side, analysts are arguing that this will at least boost credit growth, and the market's hungry for growth. So you tell us, what do you like and what are you staying away from within the lending space specifically?
Absolutely. So first, I think we don't really see a space for a very large rate cut, right? Because that has to follow the mother curve, which is always the US Fed fund target rate. And that has not really been cut in quite a while. And given where we think, the impetus of the inflation will take the US rates, India will have very little room to start cutting. I think the policy rates as well as the market rate. So Fed fund target rate minus repo or the 10-year differentials. I don't think there has been a smaller sort of differential in the 23 years that we have the data for. In which case, the RBI will also be wanting to look at how the whole tariff tantrum plays out before committing big. So if at all they cut tomorrow, my sense would be 25 bips, which would make sense, anyways, you also mentioned a lower yield means that assets gets repriced faster than liabilities. And the ones with floating sort of assets are a lot more vulnerable. And obviously the microfinance, smaller banks actually get hurt more. So if you must play something in the banking space, then the fixed lending 10-year banks make a lot more sense. Eventually this means normalize. So it's again a tactical move, not really something that you want to do every day. But for the day, I think the one with higher fixed proportion of lending and a floating sort of liability will be the ones to benefit a lot.
Okay, all right, Jigar, good conversation as always. Thank you very much. Good to have you with us here. What we'll do is we'll take a quick break and we're going to just leave you with a soundbite. TVS Motors announced Sudarshan Venu will be the next chairman of the company effective the 25th of August. Here's Parikshit speaking with him about succession plan. Listen in.
I'm very grateful to my father for the succession planning and for the responsibility and opportunity. I'm also truly grateful and for his continuous advice and guidance, which I really value and cherish, so it's really special. I think these declarations are there, and the group continues to focus on the core values and the sectors that we are in and how to grow. I'm just very thankful for the way things are, and it's always good to have clarity and focus on the future and how to really do something that benefits customers, employees, shareholders, and the whole community at large.
Welcome back. Nifty holding with solid gains. The bigger game is in the broader market. Stocks like Hindustan Zinc spiking up because of the spike we've seen in silver prices. But remember, the more liquid name, which is actually owned by Hindustan Zinc, is Vedanta. And that's why that as well has perked up a little bit. It has a bit of a headwind because oil prices are falling. But if the metal cycle is going to do well, then that conglomerate has a special situation. And that's why, in fact, we're seeing a bit of an uptick. It was in the red. It's moved up a little bit. But it's that time of the day when we move to D-Street chatter. Nimesh joins us to tell us what's he picking up. Nimesh?
Nigel, in a quiet day, I guess it's a wait and watch out of the policy tomorrow. And interestingly, while it may not be visible on the screen, but there's a bit of profit booking in the rate sensitives today. So PSU banks, real estate names, there is a bit of profit booking now after the anticipation that maybe 25 basis points is given in. So, of course, that policy will be important to watch out for. Broadly, the flows are quite mixed, and I've been saying this for a while that there is no big surprise in terms of larger flows. And for the last couple of days, it was more skewed towards because of the block deals. Again, but the trend is likely to continue. I'm going to talk about a couple of blocks there. And broadly, I guess the broader market outperformance continues. So there is a bit of sense of buying back, or at least the retail participation is back in the broader market names. But from a Nifty and a Bank Nifty perspective, it's a quiet day. I guess a wait and watch out of the policy tomorrow.
All right, but a lot of kabacha also to call it. A lot of news coming in there. What are you picking up today? The few stocks on your radar?
Sure. So the first stock on my list today is Swiggy. That's been buzzing in the last couple of days. The delivery volumes have also picked up last I checked. And again, the sense is that one large leading domestic mutual fund has been an active buyer in Swiggy of late. So that explains the bit of outperformance there. The second stock is Motilal Oswal. Within the financial names, especially the broking companies, this is relatively underperformed. We saw a block yesterday where the promoter entity was a seller, a small seller there. But again, there I understand some domestic mutual funds and one leading global fund has been accumulating off late. So that's Motilal Oswal. The third couple of stocks where there is selling today, especially the real estate names, both Godrej Properties as well as JLF, may not be visible in the stock price, but clearly there is some bit of profit booking happening in both the real estate names today. And the last is Bajaj Finserv. Again, for the last couple of days, the stock has been under pressure, and largely because there is a large anticipation of a block coming very soon in Bajaj Finserv. So that explains a bit of softness in last couple of days in Bajaj Finserv.
Well, interesting list, as always, Nimesh, and blocks and blocks and blocks, lots of blocks coming. Well, thanks for that. Mitesh is with us with what to buy or sell today for a reverse trade as we come back tomorrow. Mitesh, what do you have?
So, a BTST on DMart, I would recommend with a stop below 41.35 for targets of 41.90. And Coforge is the other one. It's near the day's high. So, come up marginally, but I think the setup is quite positive. So, keep a stop below 17.54. Look for targets of 17.85.
Okay, all right, Mitesh. Thank you very much for all the trading advice. You have a good rest of the afternoon, and we'll catch up with the markets again tomorrow. Now on to a really, really important story. There's a growing buzz that perhaps this time when the GST Council meets, and that's going to be sometime in July, they could be looking at perhaps more than just a little bit of a tinkering of rates here and there and moving of some commodities up and down, goods up and down. Sources, in fact, are telling CNBC-TV18 that the government could propose to the GST Council a much bigger slab rationalization this time in the upcoming meeting. We have Timsy joining in with what she's picking up from her sources. Timsy.
Well, yes, sources are telling CNBC-TV18 that the government is likely to propose to switch to a 3-slab structure in the upcoming GST Council meeting. At the outset itself, let me remind that this is not the first time that we are hearing about this proposal. There have been many times in the past when this proposal has actually moved forward to the GST Council, but the Council did not decide in favor of it. Let me begin by mentioning that this particular proposal actually first featured in 2017 itself, the year when GST was launched in the country by then Finance Minister Arun Jaitley, who had proposed this as a vision for moving towards one nation, one tax, where he had said that probably once revenue stabilizes, we can consider doing away with 1 slab, that is moving from 4-slab structure to 3-slab structure. And that is when he had proposed that the most possible way to moving from 4 to 3 slabs is by doing away with the 12%. And again, we are at the same juncture where now what we are picking up from sources is that the center is likely to propose to the GST Council to consider doing away with the 12% slab. The GST Council, which is expected to meet either in end of June or early July, because it has to meet before the monsoon session begins, which is slated to begin from 21st of July. So if at all Council meets before that, and given the fact that this proposal has been now doing the rounds of fresh, it could be that the centre could move this proposal to the council. Now, what is supporting centre's view to move this proposal? Firstly, GST collections are above 2 lakh crore rupees, which give confidence to the council to consider trimming the slabs. Secondly, by doing away with the 12% slab, council can think to shift the common use items which are in the 12% slab in the 5% rate, which will bring down the burden, and only select few items which are not much of an impact for the common man can move to 18%. Basically, not too much of a burden on the common man, which will give another comfort. Thirdly, by doing away with the 12% slab, council can trim the rates with keeping revenue neutrality in place, because after all, any decision on rates is taken on the fact of that it should not be impacting revenues largely or too hugely that both states and centre are unable to absorb it. And lastly, what is very important, something that I would like to remind our viewers also, that there is a group of ministers on rate rationalization which has not yet proposed to trim the rates as of now. However, doing away with one of the slabs or a slab rationalization is a terms of reference under which they have to work. And in their report till now, they have not proposed this. Council is the apex body where states and centre unanimously take a decision. Neither states can alone take a decision nor centre. So something that we'll have to wait for. But yes, the proposal to do away with 12% rate, as we know, is not something new that is coming to us. But yes, the timing right now could be suitable. Let's see what happens when the council meets.
Well, yes, the market seems to be getting a little excited about it, though as Timsy is saying, that this might just be revenue neutral. That would be the objective of perhaps the GST Council. Thank you very much for that, Timsy. That could be a very important development to watch. Guys, you remember what the last GST Council meeting headline was? Remember popcorn, caramel popcorn?
Of course. 4 slabs for popcorn.
Maybe this will be a little more sort of eventful, meaningful from a market, news, economy perspective, if indeed there are those slab changes.
Absolutely, and I think we'll keep an eye on this one. The idea was one rate, everything there, and at a low enough, so the tax buoyancy, right? But it's been buoyant anyway. Even with this complicated structure, we've crossed 2 lakh crores. 2 lakh crores, so I think it's been good in that sense. RBI tomorrow, right? So Ritu is here with the expectations in terms of what you should know. It's mostly a 25 basis point cut. I looked at a Bloomberg survey. There's one analyst, one lone economist calling for a 50 basis point cut. Ritu's with more.
We're going in with the expectation of a hat trick, with the Reserve Bank's Monetary Policy Committee expected to cut rates for the 3rd consecutive time. Now, inflation is tracking well below the RBI's 4% target, and the first quarter numbers are also likely to undershoot the forecast, and so it'll be very difficult for an inflation-targeting central bank to not deliver a cut. Now, while 90% of our respondents to the poll expect a 25 basis point cut in this policy, a smaller section believes a large 50 basis point cut could boost the credit cycle and lift sentiments. The repo rate currently is at 6%, and that is expected to go down to 5.5% in this rate cutting cycle, and that will mark the shortest and the shallowest RBI rate cutting cycle that we've had in over a decade. But a smaller section is expecting the terminal rate at 5.25%. So overall, the market sees space for another 50 to 75 basis points of cuts from here on. Now, most expect RBI will stop the rate cutting cycle by December. Some are even expecting that to happen by August. The GDP forecast for the year, that is most likely to be left unchanged at 6.5%, even as RBI takes note of some of the risks from rising global trade uncertainties. On the inflation front, though, a revision is quite likely, with CPI inflation under 4% for 3 straight readings. A majority of the respondents to our poll expect RBI to lower the FY26 forecast from 4% by 10 to 20 basis points and possibly more, which will support future rate cuts. As for liquidity, most feel RBI has already done enough, and with that record high dividend, core liquidity is expected to stay in surplus in the coming months, so don't expect any big action on that front. But here's what else to watch out for. Any tweaks to the liquidity management framework for one, and there's also been some chatter whether RBI may introduce the external benchmark linked rate, or EBLR, for the NBFCs as well, to ensure that there is better rate transmission. And of course, the street will watch out for commentary on the global macro outlook and how that might affect India. So bottom line is, this is a policy where RBI's rate cut could be predictable, but its guidance and other measures will be what the markets will look at very closely.
Thank you very much for that. It's the Nifty weekly options expiry, but things have been very quiet for the last 45 minutes or so. The Nifty has been hovering around 24,750, up close to about 0.5%, give or take a couple of points. Anand Tandon is now with us. Anand, we should brace ourselves perhaps for a rate cut, and more coming as the calendar year goes by. Would you align yourself towards rate sensitives?
Well, whether or not rate cuts, when you say rate sensitives, you are basically talking about, banks and perhaps to some extent capital goods which are affected by investments. We have not seen a great flurry of investment activity coming from the private sector. It's been mostly led by government. Therefore, it is not rate sensitive. And as far as the banking sector is concerned, whether you deliver a rate cut or not, by and large, that's the one area which is actually doing reasonably well in terms of growth and is likely to, because so far NPAs have not created a problem. So net, I don't think that there will be any significant impact. To my mind, you don't have as much as the market thinks in terms of space, not because of inflation. I mean, frankly, I don't think that the monetary committee worries too much about inflation, because if they did, they should have raised it way ahead, much faster than what they did. For 2 years, we had 6% and plus inflation and nothing happened in terms of rate increases. So if there is not, that's only an excuse. Broadly, you should expect, because the government wants to reduce the rate, that there will be a rate cut. The impact on the market, to my mind, is going to be meaningless.
Okay, that's as far as the rate cut is concerned tomorrow and what the expectation is from there. Markets continuing to move on quite nicely. Cruise mode on the Nifty, 140 points up. The mid-cap index up about 0.6%. Reddy's, by the way, has been reacting quite favorably, Dr. Reddy's, to some brokerage notes. HSBC came out with a positive-sounding note on Dr. Reddy's. Trent is up, and Reliance itself today is fighting well for the bulls. Some positive commentary on Reliance as well. By the way, I think it was JP Morgan that came out with a bullish call on RIL. Anand, good to have you on. I wonder if you've been noticing these moves that suddenly these internet platform companies, Swiggy, Zomato, the kind of moves that are happening here, especially on Eternal, Zomato. There's quite a bit of buying action that seems to be building up. Do you like any of these stocks, any of these businesses?
Well, I mean, from the point of view of execution, clearly Eternal has done very well. And it appears that, it is actually gaining market share compared to its competition. If it does become a situation, so one of the biggest issues that was there in this space is the fact that if you have well-funded companies, there will be actually a continual fight till market shares get settled. It looks at this stage that you have one company which is doing exceptional kind of performance in terms of execution, whereas the others are lagging. Now, unless the others pick up some amount of market share increases and start offering more competition, it may actually become a dominant player situation, in which case, obviously, their ability to generate revenues and margins will absolutely increase. So it's possible to explain why it is that Eternal is doing better than some of the others. It may become a winner-take-all, but for now, I would still think that you will have some more competition being put up from the likes of Swiggy and so on. The space is still fairly competitive. Would you want to buy at this stage? I think, if you are with the market and you want to be in this, then clearly Eternal is the preferred portfolio pick. One shouldn't try and do too much cherry picking in terms of seeing whether there will be a turnaround in the others and whether the execution will improve, because by and large, it's always the one that is executing well which tends to build the momentum and keep that execution advantage unless something dramatically changes. Obviously, valuations always remain a concern. But right now, I don't think that's something that the market is worried too much about. So yeah, from a portfolio construct, this is definitely still an area that is growing well.
No, got that. Anand, stay with us. What we're going to do is take a quick commercial break here. 10 minutes to go for close. Now, with regards to US, the big talking point is essentially Trump's big spending bill. Elon Musk has come in and bashed up the bill, said, well, it's an abomination, etc. I spoke with David Seif. He's Chief Economist of Developed Markets at Nomura Securities International. He disagrees. He says, well, this bill is not going to blow up the deficit. It's not a deficit bomb in that sense. It's just sort of, renewal of tax cuts which were announced back in 2017. If anything, with extra tariff collections, etc., deficits could come down. That's a pretty interesting view, I thought. So let's just listen to it. This, of course, was on our program, The Global Reset, on CNBC-TV18 Prime. Listen in.
So I don't think there needs to be a huge amount of repricing with respect to the One Big Beautiful Bill. And the reason behind that is that many of the Trump tax cuts from his first term are set to expire at the end of 2025. And so when you, most of what this bill does is renew those tax cuts, not exactly one for one, but pretty close to one for one. And, the bottom line is that I think the overwhelming market expectation was that some sort of bill, or maybe it would have been broken up into multiple bills, but that some sort of set of laws would have ultimately come into place to renew those tax cuts. So when we see these $3, $4, even $5 trillion deficit addition numbers thrown out for what this bill does, I think it's important to take into context. That's assuming that the Trump tax cuts from his first term had simply been allowed to expire. And that was never something that I think markets were really expecting. It's not as though this bill expands the deficit versus what we're already seeing today in terms of where tax rates are. And I will say that although it's not clear that all these spending cuts will ultimately make it through, when you look at the fact that there at least are some spending cuts, and then you also, separate from the bill, take into account the fact that it's likely that hundreds of billions of dollars per year will be collected in tariffs, we could actually see a small decrease in the deficit in the U.S. over the next couple of years. I don't want to overstate that point, but I do think that it's a little bit of a false narrative to say that this bill is blowing out the deficit, because the alternative would have been a big tax increase that I just don't think anybody was really expecting to go through.
Welcome back. About 3 minutes left to close today's trading session. In conversation with Anand. Anand, Reliance Infrastructure, a stock where people have burned their fingers, forgotten stock, but it's come back. At the start of May, a month back, the stock price was about 230, and now we're at 370. The share price has run up. Do you think things will turn around fundamentally?
Unless they turn around, obviously, the share price wouldn't have been moving up. There is obviously expectation of debt getting under control and so on, and that would trigger the value from the rest of the assets. Unless you are a great follower of how the debt moves, it's a little difficult to take a call, and you are going to look for various settlements, etc. So, I don't have a clear grasp on how the fundamentals look at this stage. But if you are an asset-owning company, finally there is the equity value as a residual value after all the debt has been accounted for. And from that point of view, the very fact that the market is taking it up means that there is some expectation that the market things can turn around.
Bottom up then, India's always been a bottom up story. What stocks would you like at this juncture?
So I don't see the bottom-up story right now. I think from bottom-up, it's actually the macros are looking very good. The micros are looking terrible because they are absolutely anything that you might want to buy is trading between 60 and 100 times, 2-year forward earnings. And I don't see myself buying much at that price. So basically, at this stage, I think it's best not to discriminate too much and just ride the market itself. So a good policy would be to take a mix of indices that you think are going to do well, whether it is large cap, mid cap, or small cap, and just invest in that.
And sectorally, would you have a bias? You've spoken about banks in the past, for instance, but defense continues to do well, defying all. Yeah, go ahead.
From the point of view of where the orders will come from and where the order book itself may be good, obviously, you are, besides the banks, there is defense, there is some core infrastructure companies which will continue to do reasonably well. And there may be one-off kind of situations where once the noise from the US settles down, we can figure out which of the outsourcing companies, whether it is pharma IT or it is electronic manufacturing, etc., will actually end up scoring or not benefiting. Some of the more traditional industries like textiles and garments, etc., may also find some opportunities holding up, which is why I said that there are sectors that will obviously do a little better than the others. So you will look for relative performance. In absolute performance terms, I think one has to be somewhat muted in terms of expectation.
Thank you, Anand, for joining us. We'll connect with you after the break. Just wrapping up today's trading session. Good day. It's been a fairly broad-based rally. Market gains healthy, up more than about 0.5%. 140 points up on the Nifty closing above 24,750. Sensex surging close to about 450 points. Strength in the mid and small cap index, mid cap index outperforming 400 points up, with an advanced decline ratio in favor of the advancing stocks, 1,600 stocks in the green. On the way up, Eternal shining for the second day in a row, crossed the 200-day moving average, 4.5%. Trend did well. Support came in from ICICI Bank and Reliance Industries, though banks on the whole underperformed the benchmark index with just about 0.25% gain. ICICI Bank and HDFC Bank did well. On the way down, there was pressure seen in Axis Bank, and that weighed on sentiment, and IndusInd Bank struggled in trade. A couple of consumption names. The FMCG index itself came off from the day's high in the second half of the trading session, with stocks like Tata Consumer under pressure too, Asian Paints weak, and the two NBFC twins, Bajaj Finance, Finserv, losing close to about 0.5%. All in all, we came off from the day's high, closer to 24,900, but still managed to clock in healthy gains. That said, we are still within that broad trading band of 24,500 on the way down to 25,100 on the way up. Defense continues to do well in the broader markets. That brings us to a close in this edition of Closing Bell. Don't go anywhere. On the other side is Markets Forward.